Welcome to Moving Iron with Casey Seymour and Greg Peterson, the podcast for anyone and everyone involved and interested in the business of ag equipment. If you want to understand what trends and market forces are impacting the price of your iron, you've come to the right place. Buckle up, it's time to move some iron.
Hello and welcome to the Moving Iron podcast. I've got some big news for me. I've recently joined the Farm Journal team, and they were gracious enough to put the Moving Iron podcast on their network here, and I'm excited about that. And I'm more excited about the fact that I get to share this time with the one and only Greg Machinery Pete Peterson. Greg, how you doing this morning, man?
Hey, I'm doing well, Casey, and so excited to have you on our Machinery Pete Farm Journal team. This is fantastic.
Yeah, looking forward to it. It's going to be a lot of fun, and even more. I've followed your stuff for a long time, so it's going to be a cool journey here to have this conversation with you once a week about what's going on in the equipment space.
Well, I love it, and hats off to what you built with Moving Iron. The event that you have, Casey, and the podcast, fantastic. Going deeper on the discussion around machinery values and trends. You've done great work, and just excited to be a part of what you got going here.
Well, thanks a lot, Greg. And I think the best way to start this episode off is here we are. It's 1st of February here, and a lot of turmoil in the marketplace right now. A lot of people trying to figure out what's going on. A lot of uncertainty of sorts. We got a new president in, so again, that kind of alleviated some of those uncertainties as to what team we had to play for when those things came through. But I like history, so I go back and pay attention to like what's going on in the past, those kind of things. And Greg, I'd like your opinion on this. When I look at where we're at today in the marketplace, it reminds me a lot of where we were coming out of 2016 going into 2017. And the fact that a lot of the dealerships had bled for 2.5 or 3 years through auctions and those kind of things. Commodity prices had shrank and they started to kind of rebound a little bit in 2017. We started seeing retail, the auction values start to get tighter. We're seeing a lot of that today too. So if you look at where we're at, I think a lot of dealerships are kind of done with the auction thing at the volume and scale that they've done things in the past, as well as where we see, commodity prices have rebounded. We're starting to see some movement there, and we're starting to see some closure there between the gap of auction value to retail value. Things are getting tighter. It feels like a lot of things are similar. The thing about 2017 didn't get you better, but it didn't get you worse. And I kind of feel like that's where 2025 is going to be at. So what are your thoughts on that?
Yeah, I think that's very insightful, Casey. I'm with you, history. And of course, I kind of come at it hard from the data angle, data history, been compiling 35 years, all these auction prices and also looking at the dealer advertised price point since 1999. So just over 25 years now, and comparing that to the auction values. And I think, your echo there to 2017 is, pretty good there. I think our data would, concur with down the path you're going. I think, like you say, it wasn't like 2017, 18, we saw any magical, huge rebound with, auction values, but beginning to find some footing. I do completely agree with what you were saying about, the dealer volume that was smashed out onto the auction market. I think late second half of 23 and 24 was kind of unprecedented from where I was sitting in terms of that amount of late model stuff that was hitting the auction market. And it did seem down the stretch, the late part of 24, November, December, the dealers were maybe beginning that pullback you're talking about. Those were some big losses and a lot of inventory that was taken to auction. And so early part of the year, January, February is always a little slower on the auction front. So we'll have to see in terms of dealer appetite to keep taking to auction, but the commodity prices strengthening a little bit helps. And I think what we saw back in 14, 15, 16, right in that area was steep depreciation level of drop in late model used values. And then again, it kind of flattened. And we just waited till end of 20 till corn and beans took off. So kind of similar pattern shaping up.
Yeah. And I think if you look back at that time frame, the one thing about the biggest difference between what we see now and what we see then is a lot of the stuff that we've got going on is that I call it the scarcity premium that went through COVID, right? Right. If you added it was worth whatever you could if you didn't want to pay that price, somebody else would have, right? And then you start seeing that come in there. You see that erosion of that's about 30 to 40% of what that was to get stuff back down to normal price through that auction cycle we saw through 2020 through 2023, basically 2024. And as you watch that compression happen, as you come back on the backside of 2025 into 2024, people wanting to come back in and trade, they paid X dollars for it, and now they're showing up, and it's, not only did it take off the 30 or 40% that premium was there, but you had normal depreciation on top of that. So in some instances, you saw some 50% declines in the values from the time they bought it till they went back and traded it in, which that's always a shock to everybody. And the same thing we saw in 2017 was very similar. It wasn't quite 50%. It was more like 25 or 30%. But it feels like I kind of have this theory where you've got a 3-year boom cycle. You've got about 4 to 5 year kind of rebound to get out from the boom cycle you had to kind of clean up that. And then you start easing yourself back into that boom cycle again. And if you look at where we've been at 2021, 2022, 2023, boom, right? And then now we're coming back out of that. And it feels like to me, 2025 is where we're going to be. Similar to what you were talking about. I look at it kind of the inverse that you were talking about. I look at it from when retail value exceeds 120% of auction value. That's when people start getting pushed to the auction market. And as that gap widens, that accelerates the auction marketplace, not just in buyers, but also in price decline, because you have more people showing up that are, sitting on the sidelines waiting to see what happens. And as you watch 2017, I remember going back and looking at those things, 2017 to 2018, we saw some of that show up to where it was anywhere between 115 all the way down as low as 107% of auction value. So things trimmed up nicely. Now, we still got a long ways to go before we're anywhere near 120% auction value. But what that should tell you is the auction prices should start to come up a little bit as retail prices come together. So there should be a meet in the middle there. The auction values that you're looking at here, Greg, in that fourth quarter, did you notice any peak in some values that you saw that maybe at the first year were a little bit depressed?
Well, I think, I think the one thing that we really got focused on the second half of 24, Casey, was the volume of 0 to 3-year-old, super, especially on the high horse side, and with combines and large planters, the volume of that stuff getting auctioned in 24 was very, very high. And I think for farmers out there, as we're judging against past cycles, of course, and ag, I think itself is like you described, Casey. I mean, it's boom bust, right? That's just the history of farming. And God bless, our farmers and our dealers for working through that, the ups and downs along the way. But one thing that I have seen is different this time. What is the volume the dealers put out at auction in 24 on the very late model stuff? So if you just talk combines, if I compare back to 2014, that first big year of drop, and we saw 120, let's see, the exact number is 120.7% more, brand new to 3-year-old combine sold at auction last year. So I think, that's facilitated by larger dealers versus 10 years ago. There's fewer larger dealers. It's no less painful for them to take that stuff, combines or tractors or whatever, out to auction, but maybe a little, not a little bit. They're just better capitalized. They're able to have the appetite. So if you're a farmer sitting there, in fact, I was asked this recently, Casey, last week. A farmer said, "Hey, Pete, I just want to bounce something off you. I'm looking at a deal on a S780. It was kind of out in the Midwest. Our good friends at Heritage Tractor, one of their customers, they had a very attractive price, I thought. In fact, I told the farmer, I said, that looks to me like a good number. The farmer's question was, Pete, what do you think for 2025 conditions for buying combines? And my answer was, I think, don't sit back too long, because what you described at the top, things firming up, it's sometimes when you don't realize that's happening as it's happening.
Right.
And I think the data late 24, early 25, we've seen some pretty strong auction prices. Now that might be the commodity prices up. I mean, just Saturday I was down in Northeast North Carolina. We filmed an auction for Machinery PTV. nice farm retirement sale. Now that guy's stuff was that 10-year-old stuff. Magically, of course, everybody wants that because it's such a gap between the cost of new. But he had a nice 9670 combine, 122K on that with 1,371 SEP hours. I know just recently our friends at Merritt auction January 21st, Clarkson, Kentucky, so getting a little bit south. They had a nice 20 model New Holland CR8 90, 652 engine hours. That brought 277.5, highest auction price ever on any New Holland combine in the U.S. Or any New Holland combine without a head. So I think that's jiving with the point you're making that maybe the footing is sort of firming a bit.
Yeah. I also think the plus going into 25 is the amount of equipment that got ordered for 25 delivery. It was way down. You can go look at any of the manufacturers out there, 25, 30% off. I mean, you go look at everybody's stuff out there, which bodes well, I think, for the used equipment marketplace, right? So you're going to be putting less equipment back on the marketplace. And not that anybody's going to go out and buy yachts this year with any of the commodity prices that are out there, but there's going to be a little more money towards the end of the year, in my opinion. So some of these guys, as they're looking at doing upgrades and tax buying and those kind of things, there's not going to be the brand new something sitting on the dealer lot to go buy. I mean, shoreline stuff, sure, there's always that kind of stuff laying around, but you're looking at like tractors, combines, sprayers, those kind of things, they're just not going to be there. Their option is going to be that late model low-hour stuff, which I think is going to help kind of catapult into 26. Now, I think all this is going to take place late third quarter, fourth quarter time frame, which obviously as well as I do that September through December time frame is a large buying period where they're buying at auction or off the lot. But I think as you look at this, I feel like the first 3.5 quarters of the year are going to be not stagnant. It's not the right word, because I've had a lot of conversations with guys where things are better than they expected, but when you're counting on 0 and you get 2, you get surprised pretty quick.
Yeah.
And I think that's kind of what we're feeling right now.
Yeah, I've had similar conversations, Casey, with many dealer friends. How was December? How was January? And, not to overhype it, but like you say, that the general consensus was, well, a little bit better than we thought. Yeah. So I think there's some still really strong balance sheets across farm country. And again, it's tough. I mean, but farmers are very savvy. I mean, they've done the ups and downs. They tighten the belt. But I think underlying all this, and I've been starting to try to write about this, is this boom bust that you identified, this cycle is what we're really setting up for. And now as manufacturers are even more strongly able to aggressively control production, whether, it's difficult, obviously, plant closures and stuff like that, but they're pulling those levers. And when I compare back to a decade ago, end of 13, 14, 15, 16, that drop, what manufacturers are doing now is more aggressive. So I think, like you say, less sales of new coming into 25 works to help. And all of that 120, 150% jump that dealers took the 0 to 3-year-old stuff to auction last year, that's pointing me. I really am careful about being predictive, Casey, just because I'm, report on stuff day by day. But I do think, exactly like you said, I think the first 9 months of 25, if you're looking to upgrade into used equipment, I think it's a pretty good time, to look to be aggressive to do that, whether that's at auction, talk to your local dealer. But I think what you're setting up for is a tightening. And then whenever corn and beans go up, what's going to happen is everybody and their brother is going to go, well, it's been 2-3 years. Yeah, I need a new planter. I need a new combine. Well, get in line, brother, because then I mean, that's just the way it's setting up.
Yep. And also, too, it'd be interesting to watch how upgrade kits play into this year, where there's, the new option maybe for 2026 delivery is obviously still on the board. But if you're looking to do something, how those upgrade kits going to play into that. So it'll be interesting to watch how that plays out, because that's the new wrinkle in the used equipment market. What's that look like, and how's that going to play out? So good stuff as usual. Well, Greg, it's probably a good place to stop. We've got Sean Hackett coming up here next to talk a little bit about what's going on in the commodity market, because you got to know where the money's coming from so you can spend it. So he's going to give us a rundown on what's happening in the commodity market. So stay tuned. I've got Sean Hackett back here with me on the Moving Iron Podcast. Sean Hackett is with Hackett Financial out of Boca Raton, Florida, and he's nice enough to come on and talk about what's happening in commodities, man. Sean, how you doing?
I'm doing pretty good here for a little while after a frenetic travel schedule in January, but 80 degrees yesterday, so feeling pretty good to be here after being in Fargo, North Dakota not too long ago.
So in Florida, when it's 80 degrees, do you guys still wear jackets when it's wintertime, or is that just
a jacket? A jacket.
Just a jacket? I don't know.
Yeah.
Okay. I'm actually going to get to experience a little North Florida. I'm going to Orlando this week, so I'll be there.
Beautiful.
And it's last time I was there a couple weeks ago, it was 45 degrees at night, and I thought people were going to die. And I was walking around.
Well, yesterday was much more nippy in Orlando. It was only 70 there, so just be careful.
Yeah, I can only imagine the frost warnings that were put out there. So rough time to be in Florida right now. All right, Sean, let's talk a little bit about what's going on in the markets. Tons of stuff happening right now. We've got the anticipated Trump tariffs are on one day and off the next. We got a lot of stuff happening. They've postponed the Canadian and Mexican tariff talks for 30 days so everybody can get together and go from there. China has done some retaliatory stuff that happens mid-month or so that kind of kicks back into place. So looking at the markets, you can see when the tariffs talk starts and when it stops, because the markets have a huge swing when that happens, and stuff you've talked about in the past. So I guess, Sean, as you're looking at these tariffs, what are your thoughts and how are you managing this with your customers?
Well, we've talked about this on your show that once President Trump was elected, that we were going to deal with huge headline risk for the foreseeable future, good and bad, up and down. And the only way to manage it is if you're a seller, if you need to physically sell grains, for example, and you get a big surge on a headline, be opportunistic. If you're a physical buyer and we get a big knockdown on a headline announcement of what's going on with trade and tariffs, you need to be opportunistic in looking to physically purchase, in areas that have historically looked for pretty solid as support and or resistance. So to me, that's how you handle it. You can't predict the headline one day to the next. All you can do is react if the markets give you an opportunity to physically buy or physically sell. Ultimately, we think commodity prices and grain prices are going to be working higher over the next couple of years, but it's not going to be a nice, steady, easy ride. It's going to be a lot of volatility. But in the framework of all of that, we do think the trend is up. But like we just saw in Sunday night trade where we got hit really hard, and then yesterday we had a big rebound. That's to be expected, and more of it is to come. The way Trump negotiates is to throw fantastical, abrupt action in front of people he's negotiating with, and then all of a sudden things calm down, and that's just it's just the way it is, and markets will keep reacting that way. Over time, I think the reaction will moderate. It did last time he was president, but for right now, we're still in the shock and awe of what the next term of President Trump's going to be. And we need to get our bearings with what that looks like.
Okay. One of the hardest hits things we saw here, like interim here last, kind of going into the weekend and in the first part of the week here, was the cattle trade. And if you looked where they're at with the threats of tariffs between, especially Mexico, with the amount of beef that gets shipped down to Mexico, U.S. beef that gets shipped to Mexico, as you see that, you saw a big sell off here the last couple of days. Looks like that's firming up a little bit, but I guess as you're looking at the cattle market, what are your thoughts there, Sean?
Well, we have a very, very tight cattle market.
Right.
We import a lot of cattle from Mexico. Anything that would limit the flow of cattle coming in when we already have very tight supplies, obviously, is going to create a spike trade higher, and we saw that.
Right.
And then when they said, well, not quite yet. We'll give 30 days to see if we can work something out. Then they took it right back off because they said, okay, well, if the flow is not going to stop, then we don't, we're not sure what's going to happen, but at least the immediate potential supply shock crisis that could have been in place has been at least kicked down to 30 days. And so we'll bring the market back down and give it another look. But, the cattle market cannot handle any supply restrictions whatsoever. We are starting to see more and more heifer retention in the United States, meaning the need or the trend towards herd rebuilding, which means those animal herd availability to the marketplace are going to get even tighter, especially in the second half of this year. And so we have to have the flow of Mexico and to some extent Canadian cattle coming in, or else the market will have to reprice to reflect that. And we saw that rope-a-dope real quick. And if there's some indication that we're not going to get an agreement, they will put that premium back on and maybe even more. So it's a dynamic market. What we're telling our livestock producers is, being that we can't predict all of this, and given that prices are really, really good, we would be suggesting using something like LRP, which is the government subsidized put program to lay a floor into the market that keeps your top site open while we wait to see what's exactly can happen here. Because if we get an agreement and then the cattle market gets knocked down, you're protected. If we don't and it surges substantially higher, you're able to make a cash sale at a substantial higher level. I think it's the only way that a cattle producer can manage the risk on the farm, given the inability to predict what the Trump and Mexican negotiations are going to look like.
Okay. All right. Let's talk a little bit about South American weather. You've seen about 30 to 40% of the Safina corn crop that didn't get planted on time. So it's behind schedule. So obviously they're going to knock a little bit off that right now. They're looking at a 2 million metric ton reduction to 123 million metric tons. As you look at what's going on in Brazil, I know this is something you followed quite a bit. It's supposed to be one of the biggest crops we've seen in the soybeans potentially ever come out of Brazil this year. I guess as you're looking at this, Sean, what are your thoughts on South American weather? And then as far as production goes, what are your thoughts there?
Well, certainly the rains that we've had in Mato Grosso have delayed the soybean harvest to some extent and delayed planting, but it does look like we're going to get a good, dry, more favorable period coming up here in mid-late February. And I do think even though they're late, they will catch up. Meaning they're going to get the acres planted that they were supposed to plant, albeit, maybe several weeks late, but it looks, they're definitely going to, in my opinion, going to get all those acres planted. And then once they do, then it comes down to, what kind of weather do we have going into really April and May, when corn is pollinating. The key is, remember, April and May is typically the dry season. So that we expect rainfall to be on the lighter side. That's not as much the issue as it is. This is hot. Is it warmer than normal or not? I kind of feel like it's going to be okay. Meaning, I think moisture could be on the lower side. I don't expect it to be hot. When I'm thinking through, remember last year's crop, Casey, was really bad, like 115 million metric tons, down from I think it was 135. I still believe this year we're looking at still well below that top end crop that they had a few years back, but a little better than last year. I actually think that 120, ish, give or take, is probably the right number. Like I said, still not a great crop, still not going to solve the tightness in the corn market, but I think on the margin we'll see a few extra supplies coming out of Brazil on their harvest. And so I'm not sure that I'm expecting this to be a major market mover with corn now at $5. I'm not sure it's a market mover here. I think it would have been a market mover here at $4. But at $5, I'm not sure that moves the dial unless this dry weather doesn't happen and it's further delayed, or we get some hot weather coming in. My best guess, the way we're looking at the weather, I think it's going to be okay.
Okay. All right. So let's talk a little bit about North American weather as we head into planting season. If you're deep South Texas, working your way north here, their planters are rolling. Sean, as you take a look at what's going on, the cold air that you've talked about, moving through is definitely moving in through January. We saw, and then here we are the first week of February, and it's still cold. We got a little break in my area here in the far west this week, but next week we're right back into the snow and everything else. So I guess, Sean, as you're looking at how weather patterns are shaping up here in North America, what are your thoughts?
Well, we had anticipated that we would have a really, really cold first half of the winter. Now that we look at the numbers in the books, I think it was the third coldest first half of the winter in 40 years. So that forecast that we made was certainly verified, validated, and we've seen just tremendous demand for natural gas and heating oil and such. We did anticipate that February would warm up. It has warmed up. It doesn't, and there's some, most of the cold that is coming in is going to be in the northwestern part of the United States, and demand for natural gas really is from the east and eastern cold. So overall, it looks to me like February could probably be maybe, in the 10 or 15, in that 10 to 15 year coldest. I mean, certainly nowhere near as cold as January, but what's more interesting is that the upper airflow pattern helps determine what we're looking for in the spring. As you know, Casey, we've been projecting the high order risk for a hard freeze in the spring, post-dormancy for winter wheat, which could obviously delay planting for corn and soybeans, especially corn, because you can't plant corn unless you have soil temperatures 45 degrees or warmer. And so we have this, what's called a sudden stratospheric warming event that has developed. We've talked about this in your show for years, Casey. These things develop, and this stratosphere gets super, super warm above the North Pole. And when it does that, it disrupts the polar vortex, and it projects out 45 days that you're going to get a significant colder pattern developing in North America. I mean, that's the way that's how long it takes the polar vortex to cycle around and then start to show its destabilization with colder air coming in. So if you work this through mid-February, mid-March, it would be looking at later March into April, having some very, very unfavorably cold weather when we're trying to get the grain crops planted and we're trying to grow winter wheat at post-dormancy. If it's a validation of our forecast to see this, meaning if we didn't see this, it would remove some of the probabilities of our forecast. Given that it's now absolutely 100% happening, it makes our forecast emboldened that we're on the right track with this. And as you know, Casey, last year, the Russia-Ukraine frost was a big market mover for the grains.
Yep.
If it happens here or there again, it could be another big market move for the grains. Remember, wheat's much tighter this year than it was last year. Corn supplies much tighter this year than it was last year. So an event like this year should have a more impactful move to the upside than what we had last year. And last year was pretty significant. So I like what we're seeing in the upper airflow pattern in terms of our frost forecast for the spring, both here in Russia, Ukraine. And to me, that's the real next big catalyst for the grain markets to adjust to a higher level. I think it's going to be awfully hard to break through $11 July soybeans and $5 July corn unless we have something new coming in. And I don't see South America being it. I do think the spring is when we're going to see the next big catalyst. In the meantime, we're probably set up for a little bit of a correction here, Casey, in markets as if you don't keep feeding the speculators and the bulls, they tend to lose interest and they tend to take profits. That's historically what we have noticed over the 30 to 35 years that we've been doing this.
Right.
So,
all right, Sean, that's good stuff as usual. If folks want to reach out to you, get more information about what you're doing at Hackett Financial, what's the best way to do that?
Our website is Hackett, Hackett, advisors.com. We also have a Twitter page at Faradix11. We're not habitual posters, but from time to time, we will put on interviews and tidbits of information that hopefully will help your listeners and viewers see agriculture through our eyes and see if what we do might be of value to those that have an interest in their agricultural operations.
Right on. All right, Sean, appreciate you being on the podcast. Stick around while Greg and I come back and talk about what's going on in the auction market. All right, we're back here. We got Aaron Fennell back on, talk about what's going on. We have a dealer segment, so I brought Aaron back on to talk about what's there and get that boots on the ground feel. You guys are familiar with Aaron. He's been on the show a million times at the Moving Iron podcast. What's there? So, Aaron, how you doing, buddy?
Very good. And yourself?
Doing okay, man. Got Greg Peterson here. And, Greg, I didn't know if you know this now, but Aaron's a huge Chiefs fan, so he's pretty excited about the weekend.
Huge. Low blow there, Casey, man. I know Aaron. My brother Aaron's a big Bronco fan. I'm a Vikings fan. Now, I didn't bring up your Chiefs hat in segment 1, but it's all good, man.
Yeah.
Hopefully the Chiefs can bring it home.
Yeah. In Denver, they quit playing football in December. And in Kansas City, they keep playing through February. So I don't know if you knew that.
Incorrect, sir. That was the last 8 years.
Well, at least you guys both have Super Bowl multiple wins in your column. I'm still sitting on 0, so there's that. So,
yeah. But look at it this way, Greg. The Broncos helped the Vikings and the Bills not to be in a club anymore. They were all in the 4-loss Super Bowl club.
Right.
The Broncos stand alone with 5 now.
I hadn't looked at it that way, Aaron. You made my day just a little brighter. Thank you, man.
That's what Aaron's good at, shedding light on the.
It's like it's kind of the opposite of that eternal grudge Casey mentions I have for needless things.
Yeah, good times. Well, I got Aaron on because if there's anybody that I know that really truly understands what's going on in the combine market, it's Aaron, and Aaron can speak to a lot of different facets of that. So let's dive into that. So, man, Aaron, here we are, first year, got a lot of stuff moving. Right ahead of that, I kind of call this a peak cycle of selling combines. 2 reasons. One, you're getting ready for spring harvest as those roll around, but you're also looking at deferred money that gets tossed into that first quarter of the year. What are you seeing right now? What's the feel? What's the vibe? Is it better or worse than what you thought it'd be going into 25 for 24?
Man, not better. We'll get that out of the way right away. I don't see anything better right now. I actually, off topic, late model row crop tractors that have been such a problem for 3 years, two for sure. Starting to, at least what I'm getting calls on nationally and what we're selling within our area, those are starting to come around a little bit. Obviously nobody's rushing to pay $489 for one, but they are moving more so than last year at this time. Definitely.
Sure.
You also have a lot more, much as we are, a lot of dealers doing dealer level things to make that happen.
Right.
Because everybody has seen the auction world, and that is not a very pleasant alternative.
Right.
In combines, they have been, our dealership here being right in the heart of the high plains, right in the middle of the wheat run. We do a lot of harvest combines, custom harvesters. We do for whatever reason, other than, we're also in a wheat area and guys know that, I have always sold a substantial amount of combines into Texas starting in late March. So you have, your I-states, Midwest, you basically have, we'll make it really wide, a July 15th to say September 15th window of hot combine activity.
Yeah.
Then a little bit post-harvest, pre-end of the year. Out here, we have a pretty hot and heavy combine run May, June. That's actually bigger than our pre-fall run.
Yep.
But that's, and I know dealers in Kansas are the same way, South Dakota, and that's merely because he gets his combine out earlier because he has wheat to cut. He sees what's wrong.
Yep.
Or, man, this thing's going to need 30. Why don't we just trade it? Okay, there you go. And that's what starts your early season for us combine market. Hasn't been much of that to speak of. Even the export world, I export a fair amount of combines, China, South America, Eastern Europe. That has been very, very, very weak.
All in tariffs, baby. That's what.
Yeah, well, right. But this, I'm talking, even before November 6th, 5th, whatever that was. That the November 6th was good for the domestic market, though.
Yeah.
The phone started ringing off the hook the next day.
Yeah.
But you hear, at least, the boots on the ground thing, you hear less scuttlebutt about, combines are so expensive, because turn the clock back just even a couple of years, tractors hadn't jump like they did for 18 months. And combines were, there was a bigger gap. Your tractor was 3, your combine was 5.
Sure. Yep.
Now it's 650, 550.
Yeah.
And that has had an impact. It's almost like that has taken focus off of the combines, and everything is just row crop all the time.
Yep.
Another, hate to use the word, big loser in the market is, obviously all your late model high dollar stuff. Large four-wheel drives with tracks, the 400 plus category. Those things, those are taking it on the chin too, just as bad, but it's a numbers game, So combine wholesale activity on combines has been very, very nil. Now, I know that part of that to be, I just don't have the units to fit, whether that's price, specs, whatever. But nationally, doing a lot of combines, they have just been like eerily quiet.
Yeah.
Comparatively, even from a year ago this time.
Yep. So, Greg, one thing I've noticed about year-over-year numbers, when you go back and look how things are listed, what's listed out there, the year-over-year numbers are starting to see a flattening of combines. Now, the beautiful thing about combines and the horrible thing about combines is that there's not a lot of fluctuation in combines, right? You don't have a huge sell-off or a big, fluctuation back into used inventories, because when you get your used equipment manager badge, the first thing you're told is don't let your combine inventory get out of control. And that's you pay attention to that like a hawk, right? So as you're looking at this, you didn't see a big dip coming out of COVID like you saw the other brands, because combines are kind of like the guy that gets invited to the party just long enough to bring the 12 pack of beer and let everybody else drink it, and then he has time the party's over, right? That's a combine market, right?
Hey, thanks for coming. Oh, you're still here?
So as you look at what you've seen happen in volume across the spectrum into auctions and what you're seeing on machineryrepeat.com, where are you seeing the volume of combines hit in the marketplace right now?
Yeah, I think you're on it, Casey. To me, and we've talked about this, is that I think the used combine market is 1 year ahead of the used high horse tractor market in terms of volume and pricing adjustment. So I remember being at a sale December of 22. We were filming an auction just down the road from me in Spring Valley, Minnesota, nice farm auction. Everything sold. So again, it's hard to wind our heads back, but that was basically, I think December of 22, as I look back, was the absolute, the peak plateau of used farm equipment values that we saw with our auction data. So everything on this was two brothers retiring, and they actually had a winery here in Minnesota, if you can believe it. Cold weather grapes, but it's very good, by the way. Four Daughters Winery, check it out. But everything sold high in that sale except the combine. And when I looked at the supply side at machineryrepeat.com of combines for sale, it was like, ooh, this was, used combine inventory was getting up there. So what I saw in 23 was dealers, being very aggressive on the auction market. Very, very painful, as Aaron points out, to take those things to auction and get whacked like that. But dealers were being aggressive starting in 23 at auction. And in 24 is when the tractors were starting to catch up a little bit. So when I look at our data, and we have our machine repeat ratio figure that I've been doing 26 years now. It's the average auction price divided by average dealer ad price, for what it's worth, because I always wanted to track that gap to see if it was going up or down. And with combines, again, if you look at like an S780 now is at 61.2%, which is, to Aaron's point, it's like, wow, that's painful for dealers to sell that stuff at auction. Whereas I look at something like an 8R 410, and our machine repeat ratio is like 77.5%. So that's to Aaron's point about seeing some, firming up there of, on the tractor side. When we see good units out there, at auction, we're seeing some decent pricing. Now, when I post all that stuff across our Machine Repeat social media, a lot of folks comment, and I totally understand it, but what they're commenting on is where the new price point is, whether that's an 8R 410 or a X 8250 case combine, whatever. Mm-hmm. And yes, and Aaron, you mentioned that the price of new just skyrocketed. And Casey, you talked about it too, coming out of the pandemic. And to me, that's a really interesting whole topic of itself is, people, I've been doing this 35 years, and I remember back when people were saying, "Oh my God, dude, 300,000 for a new combine? That's insane. How can we do this?"
Yeah.
And here we are with the numbers we have today. So it's fascinating. The auction market, I've always loved its sort of brutal honesty.
Yeah.
So we put that up for sale, and it brings what it brings, and it's people want what they want, and it's a fascinating market. But again, I think used combines are a year ahead of the high horse tractors right now.
Yep, I would agree with that. If you look at, there's only two segments of the market right now that are showing, exponential growth still, and that's row crop tractors, basically 175 horsepower and greater tractors. And if you narrowed that down, it would be 300 to 450 horsepower tractors. And if you looked at the other one, sprayers is another one that took off, and it's still exploding. I'm interested to see what numbers look like inventory wide across the open spectrum going into the next quarter. Typically, this is a time frame when a lot of combines get delivered this time of the year, between January and March, right? A lot of the custom cutter stuff gets delivered. A lot of those kind of things you see coming in. I'm really interested to see if the combine market used inventories don't take a little bit of a dip going into the second quarter. You saw a little bit of a dip going into the fourth quarter, and I thought, it's finally happening. We're going to start seeing things going down. Well, there were a bunch of deliveries that came in on the backside of that, and I kind of thought that most of those had gotten delivered, but there were a fair amount of those that got delivered, and we saw a little bit of a spike up. It wasn't anything crazy. Everything else took off and ran. The only thing that didn't, what you would expect to see that time of the year, were planters. So the only thing that really didn't have if you're getting your planter now, you got bigger issues, whether you didn't have your new one to get planted, or you got to sit on yours for a while before it gets there. But as you're watching those things take place, what do you feel like right now, Aaron? You feel like there's some flattening of the curve there as far as inventory goes, the guys you're talking with?
Oh, yeah. Yeah. You're talking from a numbers perspective, just more so than dollars, right?
Yep.
Yeah. From a numbers side, it's definitely fixing itself to a point. God bless $4 corn for that, right?
Right.
That puts the kibosh on. Well, why don't we just get 3 of them?
Right.
And that taking place across the entire nation is what created the row crop tractor problem that really never used to be something to keep an eye on. It was the last thing on the shelf to worry about, But yes, to your point, your multi purchases are slimming up. Your even annual roll, if it's a onesie twosie thing, even that is slowing up. So we are going there's going to be we're going to get through it, to sound like the guidance counselor. We're going to get through this, but it's not going to be very quick, and it's not, trying to think of the right way to say it. It's still not right. You know what I mean? It's going to take more than just the numbers, more than just the number of units going down to fix what problems there are. It's back to, like we said last year a couple times on the podcast, 14 versus 24, you had 10 over here,
right,
that were 2 million.
Yep.
Now you have 4.
Right.
And that, from the dealer mindset, even farmer liquidation mindset, losing 2 million on 10 is, you can, there's all kinds of places you can put that in your losses columns, whatever, to subside some of the pain.
Yeah. When
you're doing that on 4, that's cards on the table. That's it.
Yeah.
So yeah, the numbers are going down. To your point a little bit ago, Casey, sprayers are, I think a lot of that, this would make you chuckle. I think a lot of the sprayer action happening right now is 1% based on tech.
Oh, yeah.
Updating for technology.
Mm-hmm.
No other reason. So there's I think that is what's fueling the sprayers. So that will, there again, once everybody gets to where they need, that'll kind of subside.
Yep.
The problem is more so the industry as a whole has got to figure out how to make that first rig, with new prices being what they are, figure out how to get that new rig in better without losing the guy.
Yep.
Which that's forever the challenge. How do we get that cheaper? And George doesn't care to pay more so his neighbor can get his trade-in priced right.
Now you're getting into what I was going to ask you guys for your take on this, because when everything slows down, when the merry-go-round slows down and belts are tightened across US and Canada, so not as much new is sold. Casey, we talked about we're playing into more of a boom bust cycle. Not everyone buys new. So Aaron, you mentioned the multi-unit, the mud deals, and we understand why those are slowing down. But I'm getting more nervousness from the farm audience, from the guy who was the third buyer. And, if things were drying up, slowing down at the top, and, let's say 6 months from now or 12 months from now, something happens and it's, hey, now it's time to upgrade my combine. All of a sudden the playing field changes underneath, and you've got problems for those guys. I'm just curious your guys' take on that.
Well, I think like you're talking about there, Greg, there's the first 3 years of the 1-year-old, 2-year-old, 3-year-old stuff. That really is what dictates the marketplace, right? That's what's really driving what the used market's worth. You get to that third guy. I had a conversation with a guy probably 6 months ago, something like that. And he was trading in his combine, and the combine he was trading in was, 5-6-year-old combine, something like that. And the trade difference was more than he paid for the combine when it was new. He bought it brand new, and it was $100,000 more than he paid for the combine when he bought it new. And his question to me was, how am I supposed to make this work if I'm basically buying a combine and a half again for a used combine that's got 500 or 600 hours on it, right? And I said, I didn't really have a good answer for that. The only answer I really had for him was the world that we live in used to be, when you look at interest rate or price increases and stuff like that, about every series that came along, the price of that machine jumped up from about $100,000 on combines, really, if you take a hard look at that. If you look at where a 9770 started in 2008 to where it ended in 2011, there was about $100,000 jump in that. If you go back and look at where a 60 series started and where it ended, it was like an $85,000 jump. And it was a percentage that you kind of saw happening there.
Right.
What we see happening now is, as those series creep along, that percentage is gone. It's not even in the picture anymore. And that percentage is so far gone. Now it's starting to settle back down because price increases aren't, you're not getting 10% price increases in a year anymore. You're just getting one
or a month.
You're getting just 4%ers as they come along throughout the year.
Right.
And as you watch those things tick along and kind of think, every 4 or 5 years, a new series of a machine comes out. So you're going to be looking at anywhere between 12 and 15% increase between the time it started to where that series ended. Now, 12 and 15% between what a 60 series combine was, and a 12 and 50% on what a X9 or something like that is. We're talking real dollars now, right? And those dollars keep getting bigger and wider, which goes back to the theory. The thing I can only tell someone when they're looking at that is, have that in mind as you're looking at your trade cycle, and you either need to make your trade cycle longer or you need to make it shorter. And I talk about buying groups a lot. We've got the A, B, C, D buyer, and where they fall into those buckets at. And those buckets, those used to be pretty pliable walls, right? Everybody was a ghost. You can kind of walk through a wall and get to the next bucket pretty simple. Today, you can't do that. They're hard and fast, 10-foot thick concrete walls, and it's hard to navigate your way through those because of where does that put you at in your trade cycle. And once you get locked into one of those areas, you have to have either hard break one way or the other, and it's kind of painful to get over that wall. So as I look at this, I see a lot of I guess, changing of the buying patterns in the market, right? What farmers are going to be kind of relegated to, for lack of a better term, when you start looking at where used equipment falls into this mix.
Well, and to your point, Casey, a lot of dealerships across country, specifically with combines, used to have everything, the tree.
Right.
This guy always bought this guy's. This guy bought his. This guy bought his. This guy bought his. There is none of that. Right. None of that anymore. Part of that is, just like in 12, we lost our A-B+ guy to new.
Right.
Okay. Just like in 14 through 17, what have you, now we got to fix that all over again. And the price of the machine gets him back where he was.
Right.
Price of the machine coupled with the price of commodities gets him back where he was. And that industry health is what we need.
Right. When
we hit these spikes and that A-B+ guy jumps to new, that is then it's like how long trains stops.
Yep. Ripples.
Yep.
I've been at 35 years tracking the market daily, guys, and I remember telling people, rough calculation, you guys could correct me, but I always figured 4% cost of new up every year roughly. But I remember back when ethanol boom hit late 07 into 08, I think the cost of new, it didn't jump anything close to what we saw through the pandemic. So the pandemic, and we understand, I mean, the labor costs and worldwide shipping and supply chain mess, but the jump in cost of new across the board, it shouldn't surprise any of us farmers, dealers, that there's going to be some major shakeouts in dealing with these increases. And now we're starting to see, real world how some of this is playing out. And it's pretty significant stuff.
Yeah, absolutely.
Across the board on everything, right? Went and looked at a car for my wife the other day, and it was $85,000 just to get 4 wheels. I couldn't believe that. I was like, holy crap.
I stood at an auction Saturday in North Carolina. It was an 08 Chevy 2500 gas, 52,060 miles on it, went for $31,000. And I thought, 17-year-old pickup. Wow. But what does everybody say? They all say, well, what's a new one cost? So it drives it. It's the conditions for new sales and realities of the used market have always, and I think always will be, connected at the hip.
Yep. I don't want to live in it though, Greg. I just want to drive it. That's
yeah, exactly.
Right on.
Can you finance that with Fannie Mae?
I did hear a cute combine or a pickup story, and I was in Kentucky, middle of December. We were filming an auction in I'm trying to remember the name of the town. I'm old, so I'm gray hair, I forget. But Western Kentucky, and the farmer at the top, I get to know him. He goes, Pete, it's very simple with me. It's 2 things. I like John Deere tractors and I like Chevy pickups. And I looked at my auctioneer friend, Gary Allen Taylor, and I said, Gary, you're driving a Ford. How did that go when you drove up to work on this sale? And the farmer, his name was Dale C., great tobacco farmer. He said, Pete, we worked through that. A lot of love for brands, whether it's, red, green, and the pickups are even more so, I think.
Oh yeah. They are here
for sure. Aaron's a big Ford guy. So
Aaron, what is it? Are you Chevy? I
am like a rock all day, every day, sir.
Okay. So Casey's trying to paint you as a Chiefs fan in a
You're driving a Ford. Yeah.
Yeah. Okay.
Excuse me while I go hop in my Magnum outside too, real quick.
Well, I try to be Switzerland, guys. I love them all. So it's, I like reporting on what they sell for. So
there
it's
you go.
Fun.
Yep.
Quick side note: that was a hell of an auction. I watched that.
Oh, North Carolina
recently, on my DVR with the 55s on there.
Oh, yep. That's the sale. That's
very nice. Very nice.
Behind the guy's 55 track, and those 4455s, unbelievable. $5,500 went for $74,000.
Yeah.
And see, now when I post that, a lot of people will say, "Oh, a collector bought it." No, it's it's bought to put in the field because it's the guy's favorite tractor. And part of the thing that freaks me out, guys, is that So I started in 1989. That's when those 55s came out. And now to have them be 35 years old. And if I think back when I started, a 35-year-old tractor was like a John Deere 70?
Yeah.
And it's like, dang, I am getting old. But hey, I remember being out at that auction. What was it, 2014 with you guys out in Panhandle there. And it seems like yesterday.
Yep.
Still feel the pain from that auction. That was yesterday. Right on.
Well, see, now that's the interesting thing about this. I like this dynamic because from the dealer side, and I'm a son of a third generation dealer. I understand that pain of those losses at auction, but I'm reporting on the auction. And so then I come in and say, that was the second highest auction price ever. And I know a dealer might say, oh man, we wish that was higher. But again, it's all connected, right? So that price of new, like you said, guys, it sort of dictates everything.
Yeah, that is sure. Well, I feel that's probably a good place to stop. Aaron, folks want to reach out to you. It's the easiest way to do that.
I'm pretty active on Twitter, just at Aaron Fintel. I'm on Facebook if you want to find me there, or call me or text me, 308-760-1193.
Right on. Greg, I don't really need to tell this, but if people want to reach out to you, what's the easiest way to do that?
Just type Machinery Pete into anything on the internet, and hopefully we'll pop up. But no, we thank your listeners, Casey, for hitting our website. We really appreciate it, and again, it's been a fun journey over these years, and we appreciate everyone's support.
Right on. Well, this has been a good way to close down the first episode of the reboot of the Moving Iron podcast. Glad to have both you guys on here, and we look forward to doing it again. So we will catch you again next time. For that, I'm Casey Seymour with Greg Peterson and Aaron Phillips. It's Blue Smart, folks. Out.
Thanks for joining us. We'll see you again next week. And remember, Moving Iron is available on Farm Journal's YouTube channel and anywhere podcasts are found. So until next time, let's move some iron.